So hi, I want to talk to you about trading correlations and using correlated assets as a leading indicator in order to time your entry and exits. Can I just check everybody in the room if you can hear me, if you can see my screen? This is a video replay of a live trade of mine during an FOMC trade. On the ladders, we have the S&P, and the current ladder on the left is showing T-notes. The tab here is the Euro US dollar, and then to the right, gold. And here I've got S&P, gold, Euro US dollar, T-notes. Now, you can see that the market has moved in a hawkish manner after the FOMC statement, hawkish meaning dollar strength. So that dollar strength, meaning the euro versus the US dollar, has moved lower. Obviously, as a correlated asset now, US bonds have also moved lower. Higher interest rate projections, this will weigh on bond prices. So the dollar moving higher, meaning the euro dollar has moved lower, and bond prices have moved lower. A stronger dollar weighing on gold. Gold and the US dollar have an inverse relationship, so gold moving lower. And the S&P beginning to move lower because of tighter rates, tighter monetary policy not being good for equity markets. So you can see at the moment, here on my ladders I've got no position across these different assets. But if I play this video slightly, I've now just entered into a short gold position of 3 contracts. And can you see why? What you can see here is that the euro dollar is moving much more aggressively than the other assets that I'm looking at here. In fact, the euro dollar has now broken the low that we saw yesterday. And just looking at the other assets in comparison, gold isn't really that much lower than where it was trading 90 minutes beforehand, whereas 90 minutes ago, the euro dollar was trading much higher. So the reason why I sold gold here is because the euro and T-notes had already made their move. They had, if you like, agreed that this is a hawkish statement, whereas gold hadn't actually yet caught up with that picture. So let's have a look and see what happens. Now you can see I haven't yet put my stop in. I'm just watching this, and the euro dollar is trying to break S1. The S&P's going, T-notes are going.
Around bottom of the hour.
And the euro's gone again, so gold now starts to play the same tune. Basically, these 3 charts, euro, T-notes and gold, T-notes and the euro, they have to say the same picture. If this is hawkish, then they will move in the same direction. Euro and the T-notes are still going. Gold hasn't yet moved, and this is quite frustrating for me at the time. I'm going through, I'm sure you guys have experienced those type of frustrations when you're certain that these correlations should play out. Can you see the euro has broken S1 now? T-notes are still going lower. Gold is taking its time. I've only got 3 contracts on this trade. Euro back up to trade S1. I've only got 3 contracts on, and it's taking its time certainly, but you have to agree with me that at this time the euro and T-notes are showing a much more hawkish FOMC than gold. In fact, T-notes are now making new lows again. So I'm in no panic in this trade, because I know if T-notes and the euro continue to do this, gold will show the same picture. Now it starts to move. Okay, now other traders come into this trade in gold. It's up $400 now on this gold position. We're just pushing down to make new lows. And pop, it's gone. Okay, so $500-600 now on this gold trade. But can you see what did that take? That took about 90 seconds of pain. $800 now on this gold trade. It's certainly volatile, isn't it? I'm surprised I haven't taken one off by now. I have. Yeah, there we go. So I've only got 2 contracts left on this trade, practicing what I'm trying to preach you guys, scaling out of a profitable position on the way whilst that position's moving in my favor. Just 2 contracts left on this. But did you see how that took about 90 seconds? T-notes and the euro were both moving lower, showing this was a hawkish announcement. And looking at those 3 together, T-notes, euro US dollar and gold, it was gold that was the laggard. Gold hadn't moved yet. So it was gold where there was an effective arbitrage opportunity as gold moves inversely to the US dollar. So now I'm scaling out a little bit, looking to see where perhaps gold could move if this move is set to continue. And I'm pleased I took one off where I did, as I often talk to you guys about. Now gold's bouncing back higher. In fact, it's coming back right to almost where I entered it first of all. So this is why you have to, take those contracts out on the way down or on the way up as the market moves in your favor. It's back to where I entered now, all the way back. Especially over high volatile events, because the duration of the market moves. You've got no idea how long that's going to last for. By taking some of the risk off your position, it allows you to breathe. And you can see now T-notes starting to come back up to S2. So what I've done is I've entered into a short T-note trade here. Classic entry short on S2. Can you see that? T-notes came back up to S2. The Euro's still way below its S1. So there was a classic entry short on S2 using the technical level to trade in the same direction. This is still hawkish. I've still got my view that this is a hawkish trade. Now the S&P is continuing to march lower. Now that might make this T-note trade a little bit difficult, because if the S&P continues to move lower aggressively, then T-notes may be supported as a risk-off trade. But as it is, that classic entry at S2 starting to work. And I wasn't obviously the only one to do it. You saw how T-notes came back up to S2 to allow for the classic entry short. And it's at these periods when you're in a trade, at these periods when it really does test the trader. This is the period of uncertainty. This is the period of greed versus fear. This is the period of your resilience, how well you manage these trades. The best thing that I did here, without any question, was my ability to take one of those gold positions off, one of the gold trades off. As we moved lower, I took advantage of that volatility. So T-notes now moving back down to the lows. This T-note trade up over $700. T-notes now moving back down to the lows. That was the classic test of S2 that really allowed me to join this trend short. I've still got the short 4 on, so I'm hoping. This this trade was a while back now. There we go. Now I'm only short 3. So I would have taken one of those contracts off, practicing what I preach again, scaling out. I was short 4, I'm now only short 3 on US T-notes. I was short 3 on gold, I'm now only short 2. Here we go again. Can you see the euro dollar continuing its march lower? But all of this short-term volatility that can whipsaw traders in and out over this type of market action, being able to be absorbed because of taking those contracts off when it's an opportune moment to do so. Gold is really not moving here. It's not being incredibly willing. It's being stubborn, I would say. And I'm sure you guys have experienced that when you're in the trade. It seems to be that you're in the only asset that's not actually moving. And the danger here, S&P getting hit again. The danger here would be now to continue to add to this gold short because you're sure that it must go. That's when you can make a real dog's dinner of this. No, I got in the trade. I've just got 2 contracts left. The fact that gold's not really moving is a slight concern. And here what's interesting actually on my trade, it looks like now I've got 3 in gold. It looks like I actually did add 1 more onto this trade, so that's quite dangerous, I think. That can make the situation much more difficult. And the reason for adding is the continuation of the move lower in the euro versus the US dollar, but you'd have to be careful here because you've also got equities moving lower. Now, this is the danger with correlations. Clearly, gold and T-notes should move lower if the dollar is strengthening. Yes, we all know that. But at the same time, equities are moving lower. And if that creates a risk-off environment, then gold and T-notes will also move higher. They'll move higher because they're safe haven products. So there's a bit of a conflict here, potentially. This move in the euro versus the dollar, so a strengthening dollar, that should move gold and T-notes lower. However, this move in the S&P in equities could in fact support gold or T-notes. Here you can see I'm looking to add some further studies to this trade, put the pivot points back on that gold position. And you can see now what's happening in gold. We're just trying to consolidate that move below S1. And again, things pause, start to calm down somewhat. We've just got now 2.5 minutes left of this trade, really. Okay, and you can see I'm trying to, can you see my limit order there? Just been filled, so I've now taken another one off T-notes. I've only got one left on T-notes. I've taken another one off gold, so I'm just back to being short 2 in gold. So, you know, each time that we've had these waves, I've been able to use these waves to my advantage to scale out of some of those positions profitably. T-notes now making new lows. Now, what's interesting is how do you think I feel now T-notes are making new lows, even though I've taken 2/3 of my position off already? How do you think I feel? Well, actually, I feel fine. I feel fine because I'm still short one. So I'm happy that it's moving lower. Whereas should it be moving higher, should this trade not have moved in my favor, then I'm also happy because I did the right thing by booking profit on the way. I was saying to the guys in stage 2 at the moment, you know, you've got to be able to use your size to your advantage. It's like being a tennis player. If you're a tennis player with only a smash, then that's trading with one contract. You're in or out. It's all or nothing. A boxer with only an uppercut. Hang on a minute. Look out here, guys. Can you see that the S&P has rebounded now? So we were getting that push lower in the S&P, and it's just pinged back up to where it was before this data came out. I've now only got one contract left in gold and one contract left in T-notes. So it's just one contract left in. So pretty much now, for me, the trade is almost over. At one point, I had a total of 7 contracts on these 2 trades, on these 2 correlated assets. Now I have a total of 2 contracts on. 2 contracts only. Okay, just a few moments left of this trade, interestingly enough. So the euro moving down to S2. But do you guys see here how by effective use of size and orders, those waves of volatility and uncertainty, you're able to manage those type of waves rather than it being an all or nothing decision. You know, a trade that, you know, it has to go well or it has to go badly. Now in this current position, it doesn't really matter if this market moves higher or lower. Okay, so I'm out of my T-notes position, no position on T-notes. And gold has now just taken a further move lower, and that's it, finished. So I hope you found that session useful. I just wanted to recap a trade that I recorded that used correlations between assets over an FOMC event. That was looking at gold, T-notes, and the euro dollar, and looking at how each one of those assets was moving as a leading indicator for where the other asset would go. Thanks very much. I hope you can use this in your trading.